Hey everyone, welcome to our weekly live Q&A here on the YouTube. I'm Dave Keller, I'm the Chief Market Strategist at StockCharts.com in a somewhat rainy Redmond, Washington. We haven't had rain, we've had more wildfires than rain recently, so this is actually kind of a nice return to the normal weather of Seattle, I would say. But it's a pleasure to be live with you here today. What we started doing was doing a weekly Q&A format. So this is an open discussion. I'm going to start with a couple charts that I think are top of mind for me. Of course, NVIDIA's earnings sort of at the forefront of my thinking, and I think the market's thinking. You're seeing a nice rally in growth sectors leading into that announcement after the close today. So we're going to start there with NVIDIA, maybe another chart or two, and then we're going to go to the Q&A. So if you're watching and if you're listening, go ahead and pop your questions into the Q&A as they come up. Don't be afraid to pop them in there, and we'll get to as many as we can with our time together. But it'll be a pleasure to answer your questions. And again, questions can go anywhere. The focus of stock charts and the focus of what we try to do is illuminate the markets using the toolkits of behavioral finance and technical analysis. And what I mean is how you think, right? What's happening between your ears, what's happening in your head as an investor, and then how you can use technical analysis as a practical toolkit to address those behavioral challenges. And I've found by having a consistent process of following the charts, you won't be surprised as much. You'll have a much better sense of what's working and what's not, a sense of changing tides and inflection points as they happen, which potentially is where we're sort of in the middle of right here. We're starting with a chart of NVIDIA. We're actually starting with a chart of the overall markets here. The Nasdaq pushing higher again today, up about 1.4%. The S&P is up about 1% to 4430. When you look at the stocks on the move today so far this morning, it's a lot of growthy names up at the top of the list. Names like Netflix popping higher, I think, in sort of this overall magnificent 7 move to the upside. Let's focus on NVIDIA here to start with. So NVIDIA's earnings, of course, after the close today, and I think when you think about market conditions in 2023, I think years from now, when we look back and think about what 2023 meant, certainly the first half of the year, if not the first 2/3 of the year, all about the AI frenzy, right? This idea and this promise of artificial intelligence. ChatGPT kind of came out of nowhere, and all of a sudden we're all bidding up AI-related companies. And not too long ago, sort of this race, this FOMO of companies trying to inject all of their, how much they were doing with AI to justify sort of higher valuations along with other growth names. NVIDIA, of course, potentially the best example of that. It's been a triple off of the lows at the beginning of this year. So back in January, it's at 140. Today, we're around 465. So this is a stock that's already gained quite a bit. And I think that is part of the story today. Today is not a vote of confidence or no confidence on AI or the future promise of that technology. I think undeniable, similar to blockchain technology or driverless vehicles or moving to electric propulsion and all those sorts of things. These are all broader secular themes that will certainly play out. The question is the investability of those themes today and how attractive stocks are, what their valuations are relative to those expectations, and how long it would take to play out. So the reality is NVIDIA has already gone up quite a bit. The rally phase that we saw really starting in October of last year but accelerating in January arguably stalled out in June and July, right? As Apple and Microsoft all making higher highs in July than gapping lower. NVIDIA is one of those names, kind of like Alphabet, that's actually held up okay, still above its 50-day moving average, but now testing resistance, we'll call it right around 480. So I think the idea that today will be a non-event probably pretty minimal. I would say this is a binary outcome kind of day, which means NVIDIA either gaps up quite a bit or gaps down quite a bit. And I know that's tough to plan for, but that is the reality of a company with a pretty important earnings report. The last 3 reports have been pretty positive for NVIDIA. We've gapped higher, in some cases dramatically higher, 20-30% higher. Think about what would happen in that environment if NVIDIA gaps up to 500 tomorrow, what that would mean for expectations for growth stocks. Again, given the backdrop of higher interest rates and a more sort of somewhat hawkish Fed. On the other side of this, let's say NVIDIA disappoints, and this is sort of the commentary really more talks about the valuation component, talks about the promise of AI, but the short-term issues. You can see NVIDIA gap down very, very quickly, and 400 a clear support level. So as always, we look at where we're at. We look to the left. highs around 480, low around 400. I would look to see which way we break out of that range. I would argue most likely the next leg for the markets follows that gap in NVIDIA. Now, this is with the big asterisk on that point that Friday we have Powell's comments from Jackson Hole, and of course that has market moving potential as well. So we'll get to we'll think about those as we get to some of the questions. Also, remember a lot of consumer names like Ross Stores actually doing pretty well today and gapping higher on stronger earnings. So let's get to some of the questions here. FCX, question number one, and thanks guys. You're welcome to ask about tickers, about particular technical indicators or examples, market dynamics, sentiment, wherever you want to go. I'm happy to do it. So FCX is an interesting chart, right? If you think about the materials sector, I think there's a lot of promise for materials, but as with growth sectors like technology and communication service, sort of the promise of AI has led to dramatic outperformance in 2023. I think the promise of a new commodity super cycle of gold getting to new all-time highs, which it's now failed to do, right? Getting above 2,000, 2,100 an ounce. We're not doing that. We've now failed and pulled back from those levels. Gold stocks have come back in the same sector as materials. So there hasn't been that upside follow through. If there's something to get encouraged about with something like FCX, it's this combination. I think overall this is a decent chart, and I'll show you why. We've pulled back to an ascending 200-day moving average, and right now looks a lot like where we were in July. We had a rally off the low. We pulled back a bit to an ascending 200-day moving average, and then we swung higher. And this is sort of building that momentum to the upside. The problem now is we've broken down a little bit, similar to like a lot of bank charts look kind of like this, where they've had a rally and now sort of broken down, like the regional banks ETF KRE looks kind of like this, and lower in the trend, but a similar kind of short-term rally that may have been pulled back a bit. But what's interesting right now in terms of the setup is you're right at the 200-day moving average. We're technically right below it, but I would say the gap down and then no further follow through to me sort of implies that this level is kind of holding, right? There's no additional selling pressure pushing us much below current levels, and the RSI is kind of holding right around that 40 level. And in a bullish phase, what tends to happen is the whole momentum tends to shift up. This is a lesson that Connie Brown first introduced me and many to with her book. Technical Analysis for the Trading Professional, I think is what it's called. It talks about sort of the range of indicators, and Andy Caldwell did a lot of work with this as well before he passed away, promoting that with RSI, thinking about that shift in ranges. I think that may be what we're seeing here. The RSI kind of holding around 40, FCX holding the 200-day, encouraging, and could be setting up for a move higher. So I would say in the short term, you'd expect a mean reversion higher. I think the larger question for things like FCX, and honestly, I would generalize to even other material stocks, even the energy space, is you're getting a bit of a bounce, but you're not really getting that blowout move to the upside, right? What FCX has not done is broken to a new high yet. What the XLE, what the energy sector as a whole has not done, is broken to a new swing high. So we've made higher highs and higher lows, but not enough to sort of follow through and get that, what we call a big base breakout, which tells you that not only are we in a consolidation phase, we're actually exiting that consolidation phase to the upside. That's what would make me way more bullish about energy than I am now. And that would also make me more encouraged about FCX. I'm more excited about a chart that's breaking out up here than a chart that's rallying off of these lows. So short term, I would say it's an interesting opportunity and sort of a mean reversion play to the upside. I think a broader theme of stronger commodity prices is a sensible one, but I would love to see follow through on the charts, which I would say arguably we've not really seen yet. FXP, okay. Wow. Okay, I was going to say a ticker I'm not familiar with. This is an UltraShort China 50 ETF. Interesting question. So what I'm going to do is this. I'm going to start with the FXI, which is not the perfect inverse of that, but pretty close, right? I mean, it's derived from the same idea. FXI, so when you're looking at an inverse ETF, right, something like the SQQQ as a short NASDAQ ETF, or like SH or SDS as a short S&P 500 ETF, or FXP as a short China ETF, there are two options, right? You can analyze the inverse ETF just on its own and treat it as a price series and use the technical indicators that you like. I actually tend to do a different approach, which is analyze the underlying, right? My goal is to analyze the S&P, the NASDAQ, the FXI, whatever that thing is that I'm making a bet on. And then think of inverse ETFs and leveraged ETFs and the options market and even plain vanilla, just long and short positions as different levers you can pull to express an opinion on the underlying asset. So when I get questions on short ETFs or inverse ETFs, as it were, or leveraged ETFs, I'm much bigger fan of analyzing the underlying thing. What's the thing that you're really trying to make a bet on? In this case, you're making a bet on large cap China. So I would start with the FXI. And then if you're bearish on the FXI, then the short China ETF could be a way of expressing that, just like the options market and just buying a put or doing some sort of strategy to benefit from prices in China going down. So having said that, right, I think there's the macro environment, there's the macro call, and then there's the technical call. And I would argue at this point, they're kind of dissimilar, to be honest with you. The macro call on China is I'm getting a lot of discussion about the economic conditions rotating lower, about huge infrastructure projects that now are no longer, really are over. They've overbuilt what the economic conditions are at the moment, and there's a lot of speculation about downside. And you've seen that here in the last couple of weeks with the FXI. So this is a long China ETF, gapping up to around 30, but then really coming back down and now testing the lower end of the range. So I think the macro thesis right now certainly suggests that the economic conditions are worsening. What are the technical conditions? I would argue it actually looks a lot like the chart of FCX in some ways, which is it's at the lower end of this range. And I think I do have a contrarian hat. It's a little dusty. I don't wear it as much as my trend follower hat, but I do have one. And if I'd pop that on right now and look at the chart of the FXI, I'm seeing a potential double bottom pattern, or at the very least, a basing pattern. And a basing pattern is basically when the market is in a range. If you can draw a rectangle around the price action, I'd call that a consolidation phase or an equilibrium phase, where the market's kind of settled in on a particular price for that chart at this time. And now it's just about where we're at within overshooting and undershooting that value. Arguably, we're at the lower end of this range and we're bouncing a little bit higher today. I think remaining in this range is a reasonable expectation. Breaking below 25, which would get us out of this range to the downside, I think would be a very negative signal. So the way that I would think of this chart, and again, putting on my, thinking of the CMT exams that I took, thinking about risk versus reward, what's the upside potential on a chart like FXI? It's getting up to the upper end of this range. What's the risk is that we break down to around 25. So limited downside and much more upside, it seems like an attractive bet. Now, with that in mind, compare that to the chart of FXP, and I think you're finding the same thing. We have broken above the 200-day moving average, but what concerns me is we're at the upper end of this range right here, right? But put a rectangle around this price action, we can see we're sort of right at the upper end of there. So a mean reversion back to the downside actually makes a good amount of sense here. The momentum is stalling out without becoming overbought. So I would say there's actually a mean reversion play back to the upside. I'd be hesitant to press the short side until we break down. I think breaking to a new low is where you start to get a waterfall decline from there. I don't think we've seen that necessarily yet. Next question, let's see, from earlier, actually from right before we started, incorporating some indicators into point and figure charts. Yes, thanks for asking about that, the PPO, the MACD. So there's a great book by Jeremy Duplessis, and the name of it, I forget. It's something point and figure something. Sorry, Jeremy, that I forget the name of the book, but it is an exhaustively researched book. And really, the second half of it is really an advanced use of point and figure using different technical indicators. They are much less commonly used than some of the basic fundamental building blocks of point and figure charting. But an interesting idea, certainly something we'll look at as we reconsider the point and figure engine. We're working on a couple other things development-wise, particularly a new user interface for our Sharp charts. And by the way, if you're a Sharp Charts member or StockCharts member, which you all should be, of course, if you go to your dashboard, go to the new Sharp Charts workbench, you'll see kind of what the UI is going to look like. The chart itself is going to look very familiar, but all the other stuff has changed. It's just a much more modern, much more interactive interface. Things are kind of compressed into different areas. The chart is beautiful as always, but your ability to edit settings and manipulate it is going to be much more powerful. And this gives us a much better building block to go on from there. So that is where we're focused now, point and figure charting. We'll get to it. Thanks for the question on that. Next question, ERV85 from Albania. Thanks for tuning in from there. If that's where you're at, it's usually said that during a year we might have 3 corrections or pullbacks. When do you think that can happen? The third correction. And thanks for the Q&A. Hey, you're welcome. It's a pleasure to do these. One of my favorite things about charts is it provides a really good visual aid for a great discussion. So while I think there are predictive values to a lot of the tools that we're going to use, I think the ability to fuel a really good discussion about the markets, there's nothing better than a good chart to sort of do that. My conversation recently with who was I talking about? Jay Woods. We were talking maybe 2 weeks ago about different corrective phases, and he made that exact same point. In an average year, there's usually 2 to 3 good corrections, and I think the one that happened. This is the chart of the S&P that I'm showing now. If you look at the pullback that happened in February and March of this year, pretty kind of standard for a bull market phase, I would argue, and I'm kind of generalizing it, right? It's about a 6-week duration from peak in early February to bottom in mid-March, and really since late March until you really could identify a higher low and recognize that shift in the trend. In terms of price, we went from 4,200 down to 3,800, so we lost about 8% of the value, generally speaking, and then we kind of recovered. And so, arguably, we're sort of in one of those pullback phases. And again, when things roll over, and when you have a gap lower and you start swinging down, you start breaking the 50-day. I don't think that's the time yet to start talking about S&P 2600 as a downside target, because obviously that's where we're going next. We could go there, but I think a lot of things would have to go wrong between now and then. I think there's plenty of warning to be had, right? So in my mind, you think of that initial break. What's that initial level that would tell you we're now in a pullback phase? For me, breaking and descending 50-day moving average is kind of my general go-to. So at this point, I think we're still in a pullback. We've gone from around 4,600 to just above 4,300, so about 300 points. That's a little under average for a pullback. So at this point, I'm kind of thinking more down to around 4,200 would be in line of the average pullback. It's only been about 3 weeks since the peak, maybe 4 weeks if you're a little generous, which means a little bit more time, a little bit more price gets us down to 4,200. Also seasonally, think about August and September, 2 of the roughest months on an average year, particularly in a pre-election year. The fourth quarter actually tends to be pretty strong. So I think the pullback we've seen so far could be part of a bigger pullback that gets us down to further downside. And again, arguably, if you're bullish, that's the best thing you could see, because the worst thing about a bull market is when it goes vertical, right? When it starts going exponential, because then you can't chase it. You feel, it's so painful to ride that up, because you're desperate to sell and not, hold on too long and Dogecoin style ride it all the way up and then lose everything and give it back. And so it's a really tough market. Something that's more of a steady, consistent pullback is actually fairly reasonable. And that's again, as a standard play within a bullish phase. So I would argue, I think this is one of the pullbacks that we will see. My general sort of base case is we pull back to around 4,200. We have a strong fourth quarter, at least a fourth quarter that gets us back into this range and sets us up for a sort of a strong beginning to next year. But we'll see. But thanks for asking about that. And you're absolutely right. But most bullish years actually have consistent movements like we've seen right now. Cloud asks, hello, Microsoft has taken a beating but has been ripping the last few trading days. Is this related to the resurgence of the AI frenzy? I would argue, I don't say 100% yes, because I'm sure there are other things going on, but I would say 99% yes. If you think about what the market is thinking here put yourself in the shoes of the average investor, whoever that might be in your opinion. In mid-July, right, we're making new highs. The benchmarks are going higher. Growth is working big time, particularly the biggest growth names like Microsoft and Apple. Fast forward 4 weeks, and you can see a chart like Microsoft, which is making new highs in July, is now pulling back quite a bit and shedding 50 points, 15% or so in the last couple of weeks. I think the question right now, I think NVIDIA's earnings today bring up a broader question, which is that enough of a pullback that we can reset and sort of get re-excited about AI all over again? I don't think so. I mean, it could happen. And certainly, I mean, NVIDIA comes up with just blowout earnings with tons of optimism about it's just going to get better from here. The market's going to rip to the upside very, very quickly. I think that'll be a big sign of optimism. It's just amazing to me how this is happening. Such a disconnect between the promise of AI and the fact that these companies are bid up now when higher rates make those future earnings just much less meaningful today, right? Higher interest rates mean the growthy benefits of growth, which is buying and riding those higher. It's just less attractive. That's what higher rates basically are implying. So the fact that that is happening all at once is an interesting juxtaposition of market narratives. I think it's a fascinating one. And what's really cool is today we have NVIDIA's earnings, where I think we'll learn about sort of the promise of AI and, again, valuations and what the reasonable expectations may be. And then the Fed on Friday with Powell's comments. And between those two, we'll probably have a lot more clarity on there. I would say this bounce in Microsoft makes sense as a counter-trend bounce, given the fact that growth stocks have come down. Anytime you have a pullback like this, it's reasonable to have these bounces higher. I think this could set us up for the next leg down. That's kind of the general base case that I'm thinking through. But I'll be the first to admit I'm wrong when the price goes up enough. Uranium stocks, CCJ. Thanks for asking about uranium. Sort of a materials feel to the show today. Materials and AI. That's sort of the mashup we're getting so far. So a chart like CCJ, and again, I won't comment on the fundamentals behind this sort of trade as a technical analyst. I'm interested in fundamentals because they help sort of paint a complete picture. And if I'm as a well-rounded investor, let me be clear. I think you should be very aware of 4 pillars at any given point. The fundamental story, what's happening with this company. The technical story, what's happening with the stock in terms of the analysis of the price. The macroeconomic and big picture story, what is the overall environment, higher rates, lower rates, higher oil or lower oil prices, et cetera. And then the fourth one is behavioral, what's happening inside your head. And if you can get a good handle on each of those 4 things any given day, I think you're setting yourself up for success. So focusing on the technical here, it's a strong chart. And what's encouraging about the equity markets here, and I guess the broader markets, is there are risk assets that are doing just fine, right? CCJ looks strong. That is not the ticker of Alphabet, David. GOOGL is not a bad chart. It's actually making higher highs and higher lows. Ross Stores is making a new 52-week high today, very close to doing so. And then there are others that are in these extended uptrends that have just kind of been working for quite some time. So there are charts that are working, and I would put CCJ on that list of charts that are kind of working. I think the broader view of something like CCJ, look at the weekly chart and see the rally out of the COVID lows in 2020, strong 2021, really a sideways 2022 while the equity averages were coming down. And I would think of this as a big, broad basing pattern that we've now exited to the upside. I think that's a strong chart getting stronger. I'd be inclined as a trend follower to follow that sort of thing as far as we can. I think that's a strong chart. Let's see, next question. When can we use the CMB technical indicator with the StockCharts scan engine? I know a lot of technical indicators. I'm not sure what that is. If you ask that, Terry, would you let me know what that stands for? I'm actually not familiar with that one. And that's not often that I get to say that. I know a lot of technical indicators, but CMB, that's a blank for me. Let me know what that is, and I'd love to think about it for sure. We're adding a bunch of the StockCharts scanning engine has a lot of great capabilities. We've actually recently added a lot of our ACP plugin partners. You actually can scan on their indicators, our proprietary indicators, which is pretty cool. We have a whole broader plan to improve our scan engine. So yeah, let me know what kind of things you'd like to be included. The scan engine is one of, I think, the underappreciated parts of the StockCharts platform. So I'd encourage you to check it out. If the Fed is expected to continue interest rate hikes, shouldn't the TLT sell off? Yes, and that is how the math works out, right? It's sort of bond prices and bond yields are inversely related. That's bond math in terms of what that represents. Now, to your point, what does that mean? The TLT has been trading lower, and I think the breakdown in the TLT here in July, pretty powerful, pretty important signal. What's interesting about the TLT is it's now testing the October 2022 low. So think about that for a moment. The S&P, we're talking about, pulling back off of a new high for the year. A lot of growth leadership stocks, we're talking about pulling back 8, 10, 15%, but off of really high levels. The TLT at the same time is actually testing its low from October of last year. That's how different the return profile has been between stocks and bonds in 2023, dramatically different. Higher rates are obviously an important part of that story. I think rates go higher even further than we've seen. I would expect the TLT to go lower. And what that means for me is even if stocks continue selling off, if my choice is own stocks or bonds, I'm still going to want to own stocks, given the fact that the relative performance is still so much favoring equities over elsewhere. Got the note. You're asking about Connie Brown. Oh, yeah, of course. Okay. So Connie Brown's indicators, not in there yet. I'd love to see that. We partnered with Larry Williams on a number of things recently. We have some of his indicators that we just added. I think we have an appetite to add all sorts of things. So I appreciate that one. We'll think about it with the developers. That's actually not a hard one to do. And any indicator, obviously, we have on the StockCharts platform, super easy to add in there. So if there's anything you find you can't scan on that you would like us to, ping our support desk. That's actually a great way to do it because we actually track how many requests we get. But yeah, Connie's indicator, absolutely. We'll get to work on it. Let's see. Where are we at? Someone asked about Canada TSX attributes are all the TSX attributes now being incorporated into ACP? Great question. I'm not sure exactly what attributes you're referring to, but yeah, I think our sweet spot in terms of the coverage of our markets and a majority of our customers are in the U.S. and Canada. So anything we can do to make the Canadian markets more interesting and compelling and engaging, we're all for it. As far as I know, ACP covers things pretty well for Canada. So if there's a specific thing you feel that we're not doing, let me know. And again, ping our support desk with what you're looking for. Again, we actually, for development, we track all those requests. And anything we're not doing with Canada, we'd certainly love to do so. Let's see. I'm considering the pursuit of the CMT, but don't have any financial career background. So I'm curious, can the CMT alone get jobs in the industry? What are the common jobs for those who solely practice technical analysis? Really good question. It's funny. Craig Johnson, who's at Piper Sandler, famously said, the CFA will get you the job. The CMT will help you keep a job. And he was saying that to an audience of financial professionals, of industry professionals. And that is what we have found is the CMT helps round out your analysis. If you've gone to business school, if you've studied, you probably were underexposed to technical analysis and way overexposed to economic theories and fundamental approaches, many of which the evidence will show don't work particularly well, for the record. But I would argue charts and understanding the technical world is going to help your returns dramatically more, and just understanding how that fits into a holistic process. If you're not in the financial industry, I would say the CMT, particularly going through the study program, can be very valuable, number one, for just upgrading your use of technical analysis. If you're learning technical analysis on your own, if you're learning it from like the final bar and some of the work that I do at Market Misbehavior, that's great, and I think you're going to learn quite a bit. If you really want to get to a level of an intermediate kind of expert level in technical analysis, you need a structured approach that really goes through all of those building blocks, and I think the CMT exam process does that. We often, when we're hiring at different firms that I've been at, hiring for junior analysts, we will look for people that are in the program or have completed the program, even though they don't have the professional requirements. The CMT designation is particularly intended for financial professionals. There's an industry experience requirement that you have to go through. You have to get members to sponsor you because it's meant to acknowledge a level of experience as well as the book knowledge. But I would strongly encourage you to get to the book knowledge. Where do CMTs practice? All over the place. Places like StockCharts and other market data companies. I have a lot of CMTs I know that work in shops like this. Most money management firms have a CMT either in-house, like we did at Fidelity, quite a few in-house, or there are a lot of independent research shops. And if you look at many of the guests that we've had on our platform, like Katie Stockton and many others, All-Star Charts and so many of these others, most of our StockCharts contributors, many of them have their CMT and they have independent shops or work at independent research shops. That's been the progression of movement in the analysis or in the research realm of the financial industry. On top of that, hedge funds, trading desks, many CMTs that work in those sorts of roles. I would say the CMT is something that's going to help you understand market dynamics, and that is a marketable skill that someone will find valuable. RIAs as well, a common employer of CMTs right now. Let's see the last question. TLT gives RSI divergence. Okay, let's look at that. Yeah, I see what you're saying here, right? You're kind of highlighting on this thing, right? Lower lows in price, higher lows in RSI. Absolutely. And what's interesting, we're gapping higher today on the TLT as yields are coming down a little bit. Certainly. And I think that the question as we wrap up our Q&A here, I think the challenge for with anything like this, with interest rates in particular, if I look at the chart of the 10-year, I would argue rates still going higher. Will there be pullbacks in rates? Will there be bounces higher in the TLT during that phase? Absolutely 100%. And these are the kind of signals that may tell you we get a bit of a mean reversion here. So maybe the bullish divergence in the TLT says a mean reversion higher in bond prices, lower in bond yields, and that opens up the door for growth stocks to rally from here. That is the open question I will be keeping in my mind as we wrap up this live Q&A session. Guys, this was a blast. Thank you so much for joining me for the live Q&A. We're keeping it to 30 minutes for now. I appreciate your feedback so much on this style of show. We're planning to do this every Wednesday at 1 p.m. Eastern, so tell your friends and make sure you tune in next time. Hopefully we'll cover different charts and different ideas, and happy to go anywhere you like. My show, The Final Bar, will be right after the close today. We'll be talking a lot about NVIDIA's earnings, sort of queuing up for Powell's press conference at the end of this week, and all the charts that help you navigate the next couple days. So make sure you tune in live at 4 p.m. on our YouTube channel as well. For StockCharts in a rainy Redmond, Washington, I'm Dave Keller. Take care, guys. We'll see you later.